and actions. Bulls and bears battle in the market, and the value of your investment sinks or soars depending on the actions of total strangers. You cannot control the markets. You can only decide whether and when to enter or exit trades. Most traders feel jittery when we enter a trade. Their judgment becomes clouded by emotions after they join the market crowd. These crowd-induced emotions make traders deviate from their trading plans and lose money. Charles Mackay, a Scottish barrister, wrote his classic book, Extraordinary Popular Delusions and the Madness of Crowds, in 1841. He described several mass manias, including the tulip mania in Holland in 1634 and the South Seas investment bubble in England in 1720. The tulip craze began as a bull market in tulip bulbs. The long bull market convinced the prosperous Dutch that tulips would continue to appreciate. Many of them abandoned their businesses to grow tulips, trade them, or become tulip brokers. Banks accepted tulips as collateral and speculators profited. Finally, that mania collapsed in waves of panic selling, leaving many people destitute and the nation shocked. Mackay sighed. Men go mad in crowds, and they come back to their senses slowly and one by one. In 1897, Gustave Le Bon, a French philosopher and politician, wrote The Crowd, one of the best books on mass psychology. A trader who reads it today can see his reflection in a century-old mirror. Le Bon wrote that when people gather in a crowd, whoever be the individuals that compose it, however like or unlike be their mode of life, their occupations, their character, or their intelligence, the fact that they have been transformed into a crowd puts them in possession of a sort of collective mind which makes them feel, think, and act in a manner quite different from that in which each individual of them would feel, think, and act were he in a state of isolation. People change when they join crowds. They become more credulous and impulsive, anxiously search for a leader, and react to emotions instead of using their intellect. An individual who becomes involved in a group becomes less capable of thinking for himself. You need to base your trades on a carefully prepared trading plan and not jump in response to price changes. It pays to write down your plan. You need to know exactly under what conditions you will enter and exit a trade. Do not make decisions on the spur of the moment, when you are vulnerable to being sucked into the crowd. You can succeed in trading only when you think and act as an individual. The weakest part of any trading system is the trader himself. Traders fail when they trade without a plan or deviate from their plans. Plans are created by reasoning individuals. Impulsive trades are made by sweaty group members. You have to observe yourself and notice changes in your mental state as you trade. Write down your reasons for entering a trade and the rules for getting out of it, including money management rules. You must not change your plan while you have an open position. Sirens were sea creatures of Greek myths who sang so beautifully that sailors jumped overboard and drowned. When Odysseus wanted to hear the sirens' songs, he ordered his men to tie him to the mast and to put wax in their own ears. Odysseus heard the sirens' songs, but survived because he could not jump. You ensure your survival as a trader when on a clear day you tie yourself to the mast of a trading plan and money management rules. Psychology of trends. Each price is the momentary consensus of value of all market participants. It shows their latest vote on the value of a trading vehicle. Any trader can put in his 2 cents worth by giving an order to buy or to sell or by refusing to trade at the current level. Each bar on a chart reflects the battle between bulls and bears. When bulls feel strongly bullish, they buy more eagerly and push markets up. When bears feel strongly bearish, they sell more actively and push markets down. Each price reflects action or lack of action by all traders in the market. Charts are a window into mass psychology. When you analyze charts, you analyze the behavior of traders. Technical indicators help make this analysis more objective. Technical analysis is applied social psychology. It aims to recognize trends and changes in crowd behavior in order to make intelligent trading decisions. Ask most traders why prices went up, and you are likely to get a stock answer. More buyers than sellers. This is not true. The number of trading instruments, such as stocks or futures, bought and sold in any market is always equal. If you want to buy a contract of Swiss francs, someone has to sell it to you. If you want to sell short a contract of the S&P 500, someone has to buy it from you. The number of stocks bought and sold is equal in the stock market.
Furthermore, the number of long and short positions in the futures markets is always equal.
Prices move up or down because of changes in the intensity of greed and fear among buyers or sellers. When the trend is up, bulls feel optimistic and do not mind paying a little extra. They buy high because they expect prices to rise even higher. Bears feel tense in an uptrend, and they agree to sell only at a higher price. When greedy and optimistic bulls meet fearful and defensive bears, the market rallies. The stronger their feelings, the sharper the rally. The rally ends only when many bulls lose their enthusiasm. When prices slide, bears feel optimistic and do not quibble about selling short at lower prices. Bulls are fearful and agree to buy only at a discount. As long as bears feel like winners, they continue to sell at lower prices and the downtrend continues. It ends when bears start feeling cautious and refuse to sell at lower prices. Few traders act as purely rational human beings. There is a great deal of emotional activity in the markets. Most market participants act on the principle of monkey see, monkey do. The waves of fear and greed sweep up bulls and bears. Markets rise because of greed among buyers and fear among short sellers. Bulls normally like to buy on the cheap. When they turn very bullish, they become more concerned with not missing the rally than with getting a cheap price. A rally continues as long as bulls are greedy enough to meet sellers' demands. The sharpness of a rally depends on how traders feel. If buyers feel just a little stronger than sellers, the market rises slowly. When they feel much stronger than sellers, the market rises fast. It is the job of a technical analyst to find when buyers are strong and when they start running out of steam. Short sellers feel trapped by rising markets as their profits melt and turn into losses. When short sellers rush to cover, a rally becomes nearly vertical. Fear is a stronger emotion than greed, and rallies driven by short covering are especially sharp. Markets fall because of greed among bears and fear among bulls. Normally, bears prefer to sell short on rallies, but if they expect to make a lot of money on a decline, they don't mind shorting on the way down. Fearful buyers agree to buy only below the market. As long as short sellers are willing to meet those demands and sell at a bid, the decline continues. As bulls' profits melt and turn into losses, they panic and sell at almost any price. They are so eager to get out that they hit the bids under the market. Markets can fall very fast when hit by panic selling. Buying by happy bulls and covering by fearful bears pushes uptrends higher. Buyers feel rewarded while sellers feel punished. Both feel emotionally involved, but few traders realize that they are creating the uptrend, creating their own leader. Eventually, a price shock occurs. A major sale hits the market, and there are not enough buyers to absorb it. The uptrend takes a dive. Bulls feel mistreated, like children whose father hit them with a strap during a meal. But bears feel encouraged. A price shock plants the seeds of an uptrend's reversal. Even if the market recovers and reaches a new high, bulls feel more skittish and bears become bolder. This lack of cohesion in the dominant group and optimism among its opponents makes the uptrend ready to reverse. Several technical indicators identify tops by tracing a pattern called bearish divergence. It occurs when prices reach a new high, but the indicator reaches a lower high than it did on a previous rally. Bearish divergences mark the best shorting opportunities. When the trend is down, bears feel like good children, praised and rewarded for being smart. They feel increasingly confident, add to their positions, and the downtrend continues. New bears come into the market. Most people admire winners, and the financial media keep interviewing bears in bear markets. Bulls lose money in downtrends, and that makes them feel bad. Bulls dump their positions, and many switch sides to join bears. Their selling pushes markets lower. After a while, bears grow confident and bulls feel demoralized. Suddenly, a price shock occurs. A cluster of buy orders soaks up all available sell orders and lifts the market. Now bears feel like children whose father has lashed out at them in the midst of a happy meal. A price shock plants the seeds of a downtrend's eventual reversal because bears become more fearful and bulls grow bolder. When a child begins to doubt that Santa Claus exists, he seldom believes in Santa again. Even if bears recover and prices fall to a new low, several technical indicators identify their weakness by tracing a pattern called a bullish divergence. It occurs when prices fall to a new low, but an indicator traces a more shallow bottom than during the previous decline. An individual has a free will, and his behavior is hard to predict. Group behavior is more primitive and easier to follow. When you analyze markets, you analyze group behavior. You need to identify the direction in which groups run and their changes. Groups suck us in and cloud our judgment. The problem for most analysts is that they get caught in the mentality of the groups they analyze. The longer a rally continues, the more technicians get caught up in bullish sentiment, ignore the danger signs, and miss the reversal. The longer a decline goes on, the more technicians get caught up in bearish gloom and ignore bullish signs. This is why it helps to have a written plan for analyzing the markets. We have to decide in advance what indicators we will watch and how we will interpret them. Floor traders use several tools for tracking the quality and intensity of a crowd's feelings. They watch the crowd's ability to break through recent support and resistance levels. They keep an eye on the flow of paper, customer orders that come to the floor in response to price changes. Floor traders listen to the changes in pitch and volume of the roar on the exchange floor. If you trade away from the floor, you need other tools for analyzing crowd behavior. Your charts and indicators reflect mass psychology in action. A technical analyst is an applied social psychologist, often armed with a computer. Technical analysts believe that prices reflect everything known about the market, including all fundamental factors. Each price represents the consensus of value of all market participants. Large commercial interests and small speculators, fundamental researchers, technicians, and gamblers. Technical analysis is a study of mass psychology. It is partly a science and partly an art. Technicians use many scientific methods, including mathematical concepts of game theory, probabilities, and so on. Many technicians use computers to track sophisticated indicators. Technical analysis is also an art. The bars on a chart coalesce into patterns and formations. When prices and indicators move, they produce a sense of flow and rhythm, a feeling of tension and beauty that helps you sense what is happening and how to trade. Individual behavior is complex, diverse, and difficult to predict. Group behavior is primitive. Technicians study the behavior patterns of market crowds. They trade when they recognize a pattern that preceded past market moves. A tremendous volume of information pours out of the markets during trading hours. Changes in prices tell us about the battles of bulls and bears. Your job is to analyze this information and bet on the dominant market group. Dramatic forecasts are a marketing gimmick. People who sell advisory services or raise money know that good calls attract paying customers, while bad calls are quickly forgotten. My phone rang while I was writing this chapter. One of the famous gurus, currently down on his luck, told me that he identified a once-in-a-lifetime buying opportunity in a certain agricultural market. He asked me to raise money for him and promised to multiply it 100-fold in 6 months. I do not know how many fools he hooked, but dramatic forecasts have always been good for fleecing the public. Use your common sense when you analyze markets. When some new development puzzles you, compare it to life outside the markets. For example, indicators may give you buy signals in 2 markets. Should you buy the market that declined a lot before the buy signal, or the one that declined a little? Compare this to what happens to a man after a fall. If he falls down a flight of stairs, he may dust himself off and run up again. But if he falls out of a 3rd-story window, he's not going to run any time soon. He needs time to recover. Prices seldom rally very hard immediately after a bad decline. Successful trading stands on 3 pillars. You need to analyze the balance of power between bulls and bears. You need to practice good money management. You need personal discipline to follow your trading plan and avoid getting high in the markets. Classical chart analysis. Chartists study market action, trying to identify recurrent price patterns. Their goal is to profit from trading when patterns recur. Most chartists work with bar graphs showing high, low, and closing prices and volume. Some also watch opening prices and open interest. Point-and-figure chartists track only price changes and ignore time, volume, and open interest. Classical charting requires only a pencil and paper. It appeals to visually oriented people. Those who plot data by hand often develop a physical feel for prices. Computers speed charting at a cost of losing some of that feel. The biggest problem in charting is wishful thinking. Traders often convince themselves that a pattern is bullish or bearish depending on whether they want to buy or to sell. Chart patterns reflect the tides of greed and fear among traders. This book focuses on daily charts, but you can apply many of its principles to other data. The rules for reading weekly, daily, hourly, or intraday charts are very similar. Each price is a momentary consensus of value of all market participants expressed in action. Each price bar provides several pieces of information about the balance of power between bulls and bears. The opening price of a daily or a weekly bar usually reflects the amateur's opinion of value. They read morning papers, find out what happened the day before, and call their brokers with orders before going to work. Amateurs are especially active early in the day and early in the week. Traders who researched the relationship between opening and closing prices for several decades found that opening prices most often occur near the high or the low of the daily bars. Buying or selling by amateurs early in the day creates an emotional extreme from which prices recoil later in the day. In bull markets, prices often make their low for the week on Monday or Tuesday on profit-taking by amateurs, then rally to a new high on Thursday or Friday. In bear markets, the high for the week is often set on Monday or Tuesday, with a new low toward the end of the week on Thursday or Friday. The closing prices of daily and weekly bars tend to reflect the actions of professional traders. They watch the markets throughout the day, respond to changes, and become especially active near the close. Many of them take profits at that time to avoid carrying trades overnight. Professionals, as a group, usually trade against the amateurs. They tend to buy lower openings, sell short higher openings, and unwind their positions as the day goes on. Traders need to pay attention to the relationship between opening and closing prices. If prices closed higher than they opened, then market professionals were probably more bullish than amateurs. If prices closed lower than they opened, then market professionals were probably more bearish than amateurs. It pays to trade with the professionals and against the amateurs. Efficient markets, random walk, and nature's law. Efficient market theory is an academic notion that nobody can outperform the market because any price at any given moment incorporates all available information. Warren Buffett, one of the most successful investors of our century, commented, "I think it's fascinating how the ruling orthodoxy can cause a lot of people to think the earth is flat. Investing in a market where people believe in efficiency is like playing bridge with someone who's been told it doesn't do any good to look at the cards." The logical flaw of efficient market theory is that it equates knowledge with action. People may have knowledge, but the emotional pull of the crowd often leads them to trade irrationally. A good analyst can detect repetitive patterns of crowd behavior on his charts and exploit them. Random walk theorists claim that market prices change at random. Of course, there is a fair amount of randomness or noise in the markets, just as there is randomness in any other crowd milling around. An intelligent observer can identify repetitive behavior patterns of a crowd and make sensible bets on their continuation or reversal. People have memories. They remember past prices, and their memories influence their buying and selling decisions. Memories help create support under the market and resistance above it. Random walkers deny that memories of the past influence our behavior in the present. As Milton Friedman has pointed out, prices carry information about the availability of supply and the intensity of demand. Market participants use that information to make their buying and selling decisions. For example, consumers buy more merchandise when it is on sale and less when prices are high. Financial traders are just as capable of logical behavior as homemakers in a supermarket. When prices are low, bargain hunters step in. A shortage can lead to a buying panic, but high prices choke off demand. Nature's law is the rallying cry of a clutch of mystics who oppose random walkers in the financial markets. Mystics claim that there is a perfect order in the markets, which they say move like clockwork in response to immutable natural laws. R.N. Elliott even titled his last book, Nature's Law. The perfect order crowd gravitates to astrology and looks for links between prices and the movements of the planets. Most mystics try to hide their astrological bent, but it is easy to draw them out of a shell.